There is a combination of tax consequences that could cost a senior homeowner $75,000 when they sell a property they have owned for decades. Not because they were dishonest, not because they concealed anything, but because of one innocent family decision that most people have never even heard of. I know a woman from Ohio who learned this the painful way. She had owned her home for 34 years. She sold it last year, fully expecting to walk away, without owing a single dollar in taxes. She had lived there her entire adult life, raised her children in that house, paid it off years earlier. She ended up owing $23,400. And the decision that triggered it was made at her kitchen table on a Tuesday afternoon when she genuinely believed she was being responsible and protecting her family. It took her less than 10 minutes. If you are over 60 and you own a home, April 15th is the deadline that determines whether you can resolve this quietly or face it the hard way. I mean that with complete seriousness. I'm going to tell you precisely what she did and why it matters for you right now. But before I get into it, a brief note. Everything covered today is based on current IRS regulations and federal tax law, including the One Big Beautiful Bill Act signed into law on July 4th, 2025. Nothing in this video replaces advice from a licensed tax professional. Treat it as a starting point, not a final answer. Here is what this video covers. 4 traps. 4 completely ordinary homeowner decisions that are quietly creating IRS problems for seniors right now. Then 3 things that could actually put real money back in your pocket on your 2025 return that most people over 60 have never heard about. Then a 7-step action checklist, including a free tool on the IRS's own website that shows you exactly what information they already have connected to your property. The 4 traps spell out one word: home. H is for home equity mistakes. O is for ownership and deed changes. M is for move-out timing before a sale. E is for extra income generated from the home. If this is helpful today, please hit the like button and share this with anyone over 60 who owns a home. That one share could save someone thousands of dollars. Now let me finish her story. Her name is Margaret. She's a fictional composite drawn from real situations that tax professionals encounter regularly. Every individual mentioned in this video is the same. Real consequences, composite characters. Margaret's husband passed away a few years ago. Her daughter Sarah stepped up after that, handling groceries, home repairs, doctor appointments, everything. One afternoon, Margaret's neighbour mentioned that adding Sarah to the deed would make things simpler later. Avoid probate, keep the house in the family. It sounded like plain common sense. So Margaret did it. County Recorder's Office. A simple form. No attorney, no tax professional, no reason to think twice. Here is what nobody told Margaret. When you transfer partial ownership of your home to another person, even your own child, the IRS can treat that as a taxable gift. Depending on the value transferred, that may trigger a reporting requirement on Form 709. And when the home is eventually sold, the person you added to the deed may not qualify for the same tax exclusion you do because they never lived there as their primary residence. Margaret found out 2 years later when her tax preparer reviewed her return and said 4 words she was completely unprepared to hear. We need to talk. Every dollar of that bill was entirely preventable. The IRS does not consider why you did something. It only examines what you did and whether it was properly documented. Good intentions do not appear anywhere on a tax return. H. Home equity mistakes. Most homeowners believe that if money came from their house, it must be connected to the house for tax purposes. That assumption is completely wrong. A senior borrows $40,000 or $50,000 against their home through a HELOC. They use it to help a grandchild with college, cover a medical emergency, or pay down existing debt. And because it came from the house, they assume the interest is deductible. It is not unless the money was used to purchase, construct, or substantially improve the home securing the loan. That is the rule under the Tax Cuts and Jobs Act of 2017. If the money went anywhere else, that interest is personal interest, not deductible. Claiming it incorrectly creates a discrepancy that the IRS's automated systems are increasingly effective at identifying. Think back right now. Did you take out a home equity loan or open a HELOC in the last 3 years? Where did that money actually go? Into the house or somewhere else? If it went somewhere else, you need a conversation with a CPA or enrolled agent before April 15th, because steps available right now become significantly harder after the deadline passes. Ownership and deed changes. This is the trap that causes the most pushback when I explain it, because people hear it and immediately say, "That cannot be right. That was just a family decision." I hear that every single time, and every time I say the same thing. That is precisely why it is so dangerous. A senior adds an adult child to the deed for estate planning, probate avoidance, or simply because that child has been helping, and it feels right. What feels like a family decision is simultaneously a tax decision. And those two things do not always point toward the same outcome. Think carefully about the past 5 years. Has anyone's name been added to your property? A child, a grandchild, anyone? If yes and no gift tax return was filed that year, keep listening, because this next part is specifically for you. When you add someone to your deed without them paying fair market value, the IRS can classify that as a taxable gift. When the value transferred exceeds the annual exclusion limit, a Form 709 gift tax return is generally required. If that was never filed, that is a documentation gap sitting quietly in your financial history. And when you eventually sell, the person you added to the deed may not qualify for the primary residence exclusion, the rule that lets most homeowners exclude up to $250,000 in capital gains, or $500,000 for married couples, because they never lived there. Their share of the gain may be fully taxable. A sale that should have been tax-free becomes partially taxable over a deed change that took 10 minutes. There is also the basis issue. If you transferred the home entirely as a gift rather than leaving it as an inheritance, the recipient gets your original purchase price as their cost basis, not today's value. If you paid $80,000 and the home is worth $380,000 today, they could owe capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to current market value, and that gain would largely disappear for tax purposes. One path costs the family nothing, the other costs tens of thousands. The only difference is the timing of the transfer. Move-out timing. This is the one that hits seniors hardest, and it is the most misunderstood rule in residential tax law. Under IRS, Section 121, to exclude up to $250,000 in capital gains from your home sale, or $500,000 if married filing jointly, you must have lived in the home as your primary residence for at least 2 of the 5 years, immediately before the sale. That is the 2 out of 5 rule. Here is where it quietly destroys people. You move in with your adult children because of a health situation, or into a smaller place while your house sits on the market, or you start renting it out while waiting for a better price. All understandable decisions, all of them directly affect your residency calculation. Say you moved in with your daughter in January 2021. You kept the house, tried to sell, could not get the right price, rented it for a year, and finally sold in March 2026. You moved out January 2021. Sale closed March 2026. That is more than 5 years since you last lived there. Under the 2 out of 5 rule, you may not qualify for the exclusion at all, because both qualifying years fall outside the 5-year look-back window. If the house appreciated by $200,000, you could owe capital gains tax on the full amount. For most homeowners in this income range, that is roughly $30,000. Not because you did anything wrong, but because retirement circumstances and a tax timing rule collided in a way nobody warned you about. If you have moved out of a home you still own and plan to sell, count the months this week. The window to address this exists right now. Extra income from the home. This is the trap people dismiss first because the amounts feel small. That dismissal is exactly what makes it expensive. A senior rents out a spare room, perhaps through a short-term rental platform, perhaps to a college student, or a family member pays something modest to stay in the basement apartment. It covers the utilities. It feels like a practical arrangement. But the moment your home generates any rental income, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that income must be reported on Schedule E. Informal arrangements are not exempt. No formal lease does not mean nothing to report. Second, a portion of your home expenses may become deductible against that rental income. But without documentation, you either face audit exposure or you overpay. Third, if you later sell, the rental portion may not qualify for the primary residence exclusion. The gain gets allocated between residential and rental portions. And depreciation recapture, under Section 1250, taxed at up to 25%, can apply even if you never claimed depreciation in the first place. That spare room rented for $600 a month for 2 years can affect the tax treatment of your entire home sale. Dorothy's story. Dorothy is 68, Tennessee, lived in her home for 27 years. In 2022, a health scare pushed her to move in with her son Michael. Temporary, she told herself. To cover expenses, she rented the house to a young couple for $1,100 per month. She did not report it the first year because her accountant had just retired, and the software she used never asked the right questions. The following year, Michael added his name to the deed just in case Dorothy's health got worse. No gift tax return filed. Early 2025, Dorothy sold. 27 years of ownership. She walked into that closing expecting a clean, essentially tax-free sale. The IRS determined she had moved out more than 2 years before the sale. The rental period had changed part of the home's classification. The deed change created a gift reporting gap. The unreported rental income was a separate liability underneath all of that. Dorothy owed $23,400 across 3 separate issues, none of which she knew existed when she made the decisions that caused them. She was not negligent. She was not hiding anything. She was a 68-year-old woman managing a health crisis, a housing transition, and a family situation simultaneously without anyone telling her what she needed to know. Dorothy did not fail the system. The system failed Dorothy. But the system does not adjust itself based on that fact. That is the entire reason this video exists. Now, the other side. Money you may be leaving behind. Everything so far has been about problems. The next few minutes are about real money available on your 2025 return that most people over 60 have never heard about. The first is the senior bonus deduction. It is part of the One Big Beautiful Bill Act, signed July 4th, 2025. If you are 65 or older, you can now claim an additional $6,000 deduction on top of whatever you already deduct. Whether you itemize or take the standard deduction, it stacks on top of both. Married with both spouses 65 or older, that is $12,000 total. Available for tax years 2025 through 2028. Phases out starting at $75,000, modified adjusted gross income for single filers, and $150,000 for joint filers. For many seniors, that is $1,000 to $2,500 in real savings. This provision was buried in an 1,100-page bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the One Big Beautiful Bill? If they look uncertain, find someone who does not. The second is the SALT deduction increase. From 2017 through 2024, the state and local tax deduction was capped at $10,000. For homeowners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone often exceed $10,000, that cap was genuinely painful. As of 2025, that cap is now $40,000. For 2026, it is $44,000, increasing 1% per year through 2029. When the cap dropped in 2017, millions of homeowners switched to the standard deduction and never looked back. 8 years on autopilot. The cap has quadrupled, and their habits have not changed. If your property taxes plus state income taxes exceed $10,000, run the numbers again. Add your total SALT to your mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing right now. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, the 30% federal residential clean energy credit is still on your return for that installation. The One Big Beautiful Bill eliminated this credit effective December 31st, 2025. Systems installed and operational by that date still qualify. On a $30,000 system, that is $9,000 you do not want to leave behind. Make sure that credit is properly claimed before you file. And one more thing that has nothing to do with the IRS, at all. Almost every state in America offers a property tax homestead exemption for seniors. In Texas, the over 65 exemption can reduce your home's taxable value by $60,000 or more, saving some homeowners $4,000 to $6,000 every single year. Florida freezes your property tax assessment permanently at the value when you first qualified. Georgia offers full exemptions from school taxes for qualifying seniors. These exemptions are not automatic. Nobody sends you a letter when you turn 65. You have to apply. Call your county appraisal district this week. Ask what senior exemptions are available. Bring your ID and your deed. It takes 20 minutes. And for many people watching this, that call will save more money over the next 10 years than anything else covered today. 7-step action checklist. Step 1. Pull your last 3 years of tax returns. Look at Schedule A for mortgage interest. Look for Schedule E for rental income. Check for any 1099 connected to the property. Write down anything missing or unexpected. Step 2. Find your deed. Check every name listed. If a name was added in the last 5 years and no Form 709 was filed, that needs professional review before April 15th. Step 3. Map your residency timeline. If you have moved out of a home you still own, calculate exactly how many months since you last lived there as your primary residence. If that number is at or beyond 24 months and you have not yet sold, get professional review before the sale closes. Step 4. Check your IRS account transcript at irs.gov. Create a free account. 15 minutes. You will see every notice on file and every piece of third-party data the IRS has matched to your Social Security number, including 1099-K data from rental platforms. Step 5. Track your home equity records. Write down exactly what any HELOC or home equity loan funds were used for. If they went somewhere other than the house, your return may need professional review. Step 6. Document every rental arrangement the property has ever had. Any amounts, any arrangement, all dates and figures. A tax professional can tell you what was handled correctly and what needs attention. Step 7. Contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Ask specifically whether they have experience with IRS penalty abatement for real estate issues. Dorothy did none of these 7 things. Not because she was careless, but because nobody gave her this list before she needed it. You have it right now. Use it. Let us bring it all together. The 4 home traps. H. Home equity. Money from your house is not automatically treated as connected to the house under IRS rules. O. Ownership changes. Adding someone to your deed is a tax event, whether you intended it to be or not. M. Move-out timing. The 2 out of 5 rule does not pause for retirement or health transitions. E. Extra income. Rental income from your home changes its tax classification all the way through to the final sale. The money working in your favour right now. The $6,000 senior bonus deduction on your 2025 return. The SALT cap now at $40,000 if you are in a high-tax state. The 30% energy credit for 2025 installations not yet filed, and the senior property tax homestead exemption sitting unclaimed at your county appraisal district. If even one of the 4 traps sounds familiar, do not file this away as something to think about later. That is exactly how Margaret ended up hearing those 4 words. That is exactly how Dorothy ended up owing $23,400 on a sale she expected to be completely clean. Start with step 1 tonight. The deadline is April 15th. After that, what could have been a quiet fix becomes a scramble. And scrambles are always expensive. If this video helped you, hit the like button right now. Subscribe if you are not already here. Share it with anyone over 60 who owns a home. And drop a comment below sharing which one of these you did not know about before watching today. In the next video, I'm going to walk through Form 709, the gift tax return that most seniors never filed when they changed their deed, and show you exactly how to address that gap before it becomes a formal IRS notice. If Margaret's situation sounded familiar, that next video is made specifically for you. It is already on your screen. Watch it now because this is exactly the kind of topic where waiting always costs you more than acting today.